Well, it's probably gone better than expected. That's the sentiment we're seeing most of in the marketplace. There's a fundamental change that MiFID brought to the financial services markets, and I think people had the expectation that the worst was going to happen. But the sun's still set, the sun's still rise, so sun still rose even. And so I think from a MiFID perspective, it went a lot better within the marketplace. Some troubles, I've heard some people refer to it as mild turbulence within the financial markets. We're seeing some issues around reference data, we're seeing some issues around reporting, and we're seeing some issues around transparency. But on the whole, I think it's gone well. What we are seeing there is we are seeing some changes in market structure. So we are seeing trades starting to flow through the SIs, the systematic internalizers. Some think that's as a consequence of the smaller ticks that the SIs can quote. Others think that's as a consequence of liquidity providers and market makers being defined as SIs within the new regime. But we're definitely seeing a flow of trades into the SIs. And then most recently, we saw the introduction of the double volume caps. So ESMA issued those double volume caps, and that's having a fundamental effect on what's being traded on the dark pools, on what's actually coming out onto the lit markets, or going into the periodic auctions as a consequence of those double volume caps coming into play. Well, we still got quite a ways to actually implement in terms of MiFID II. We had the deferral around the LEI, that was for 6 months, so within 3 months' time, sometime in June, then we see the LEI regime coming back onto the table. Some discussion as to whether that will be a hard stop or not, or whether it will be extended. But in chatting to some of the regulators, we expect that to be implemented as of June, and we expect organisations to have to utilise the LEI going forward on a mandatory basis. As we come to the end of March, we start looking at the best execution regime. That first quarter is reportable in the second quarter, so organisations, particularly venues, will be reporting that information to the regulators, and so we'll begin to see how organisations are prepared to support best execution. What we're also seeing is the SI regime coming towards the end of the year. So SI determination takes place. A lot of companies have opted in to being an SI, or because they're a liquidity provider or a market maker, they're defined as an SI anyway. But organisations have opted into being an SI. Come September, October, ESMA will start stratifying them via their trades as to whether they're an SI or not. So if they cross certain thresholds, then ESMA will deem them as an SI, and all the obligations that brings with regards to pre- and post-trade transparency reporting. I think we will see some additional changes within the markets. The SI regime, the lack of harmonisation of tick sizes between SIs and regulated markets and venues, also exchanges that have an equivalence definition at the moment, particularly the Swiss exchange, where you've got a dual listed security and there's greater liquidity in the equivalent market, in the Swiss market, let's say, then we are seeing a flow of trades into that marketplace. So I think you'll see some harmonisation of tick sizes, either European venues being able to quote the smaller ticks, or as part of the equivalence process, then those venues outside of Europe being asked to harmonise their tick size with Europe. We're also seeing some discussion and debate around the transparency rules as to whether the thresholds that have been set for large in scale SSTI are the thresholds that will be set on an ongoing basis. Is everything being reported that we're seeing? Is it going through the system, and then is it becoming reported out of the system? Large in scale SSTI means a lot of trades are being deferred in terms of their reporting. A lot of liquidity thresholds mean they're not actually making it to trade reporting in the first place. And that then sparks the debate about the consolidated tape and whether the CTP will be something that's introduced either commercially, or whether ESMA will have to implement something from a public sector standpoint and do it themselves. So I think we've still got a lot to do. What we're also seeing though is how people evolve using the MiFID II data. A tremendous amount of data came into the marketplace as a consequence of MiFID II, out of the APAs, out of the MTFs, OTFs, non-equity based information. And organisations, now they're over the hump of implementing MiFID II, starting to lift their heads up and work out how they can best make use of this data in the marketplace and help them understand what's going on, either from a pre-trade or from a post-trade analysis perspective as well. So we're seeing a lot of organisations start turning their attention to the analysis of the data. I thought some of the insight that Stephen gave as to where the FCA was going, its thinking, its views on the marketplace, its relationship with ESMA post-Brexit, I thought he opened up quite a lot in that session actually, in a way. So that would actually be my highlight to date, is getting that regulator insight which you don't normally get.